Iron Financial, the only place on the web dedicated to forging you a stronger portfolio by cutting right through the market weakness. I'm your lead analyst. Today, we're putting an absolute giant under the microscope, Simon Property Group, ticker SPG. Now, they just dropped their fourth quarter and full year earnings, and let me tell you, the headlines are glowing. But our job here, it's not to read headlines, it's to stress test the steel. So the question we're asking is simple. Is Simon Property Group a fortress of pure cash flow and profit, or is it a beautiful skyscraper built on a crumbling foundation of debt? Let's get into it.
So this is the narrative you're going to hear everywhere else. The quote from CEO David Simon, it says it all. An impressive year of performance. We're talking record numbers, big returns to shareholders, operational excellence. This is the story they want you to hear. It's powerful, it's simple, and it is overwhelmingly positive. Management is projecting maximum confidence, and when you just look at the surface, they've got every reason to. The message is crystal clear. The machine is working perfectly.
Whoa, hold on a second there. That all sounds great, impressive, record-breaking. I hear those words all the time in press releases. But here at Iron Financial, we look past the shiny exterior. We pressure test the metal. So the real question is whether the engine's incredible performance can hide the cracks that might be forming in the chassis. I mean, sure, on the surface, the operational numbers, they look absolutely indestructible. But does the balance sheet, the real blueprint of this company, tell a completely different and maybe a far more dangerous story?
That's the right question to ask. And you know what? Before we go looking for cracks, we have to understand the framework itself. And the bull case for Simon Property Group, well, it's built on a framework of truly elite operational performance. I mean, you just can't argue with these numbers. So let's build this case from the ground up, brick by brick, and see just how strong this structure really is. Let's start with the engine.
Okay, first and most important pillar right here, $4.8 billion. That is their record real estate funds from operations, that's FFO, for the full year 2025. Now, for a real estate investment trust, a REIT like Simon, FFO is everything. It's the lifeblood. It's a much, much better measure of performance than your standard net income because it adds back all those non-cash charges like depreciation. So think of it like this. It's the core cash profit that's being spit out by their properties. Hitting a record $4.8 billion, that's not just good, it's a statement. It tells you the core business is a cash-generating machine running at full throttle. This is the number that pays the bills, funds the growth, and funds those dividends.
Now, here's where it gets really interesting. This slide shows that the engine isn't just running, it's actually accelerating. This 4.8%, that's the growth in their Q4 domestic property net operating income, or NOI. So if FFO is the company's total cash profit, NOI is kind of like the gross profit from the individual malls before you subtract all the corporate overhead and debt payments. This number tells you that Simon's existing properties are becoming more profitable all on their own. They are literally squeezing more dollars out of the same square footage. This isn't growth from buying new stuff. This is pure, organic, fundamental strength. It's the sign of a best-in-class operator, period.
And why is that NOI growing? Well, it's pretty simple. Because their properties are full. I mean, look at this number, 96.4%. That is the occupancy rate for their U.S. malls and the premium outlets at the end of the year. For years, we've all heard that story about the death of the mall. Well, this number is a direct punch in the face to that whole idea. You don't get to 96.4% occupancy unless you own high-quality, desirable Class A locations that tenants are practically fighting over. This isn't just stable, it's fortress-level occupancy. It gives them immense pricing power, and it proves that demand for elite physical retail space is stronger than ever. This is the foundation of their entire business model.
Okay, so the malls are full, but are the tenants inside those malls actually doing well? This slide brilliantly illustrates that yes, they absolutely are. We're looking at an 8.1% increase in retailer sales per square foot. Now, this might be the most important secondary metric on the entire board. It means the actual stores inside Simon's properties are selling more stuff. And when your tenants are successful, they can afford to pay you higher rent, they're way less likely to default on you, and they're eager to sign new leases. This creates a virtuous cycle that feeds directly back into Simon's own profitability, and it justifies those incredible occupancy rates we just saw. It's proof that their ecosystem isn't just surviving, it is thriving.
And here it is. This is the payoff. This is where all that operational strength we just walked through gets converted into cold, hard cash for shareholders. The board just declared a quarterly dividend of $2.20 per share. That's a 4.8% increase from the same time last year. Look, a company does not raise its dividend, especially in this environment, unless management is supremely confident in the stability and the growth of its future cash flow. This is them putting their money where their mouth is. It is the capstone on the entire bull case. Record cash flow, growing profits, full properties with thriving tenants, all of it leading to a bigger check in your mailbox. It's a really powerful story.
A very powerful story, I'll give you that. And it's the one every bull out there is going to tell you. But now, we do our job. We take that beautiful structure you just built, and we bring in the engineers to look for the stress fractures. We're going to examine the foundation, because it doesn't matter how impressive the skyscraper looks from the outside, if the foundation is weak, the whole thing is at risk. So, it's time to talk about the cracks.
Okay, before I just show you the number, I really need you to understand what it means. We're going to use a tool called the Altman Z-score. It's this formula that was developed by a Professor Edward Altman way back in the 60s, and it combines 5 different key financial ratios to measure a company's overall financial health. For decades, it's been proven to be a remarkably accurate predictor of corporate bankruptcy. Now, the crucial point is this. Any score below 1.8 means the company is considered to be in the distress zone. That indicates a real, tangible risk of serious financial trouble within the next 2 years.
And Simon Property Group's Altman Z-score is 1.43. Just let that sink in for a minute. This is not a borderline case. This isn't 1.79, just kind of scraping by. It is 1.43. So according to this widely respected, time-tested metric, the largest retail REIT in the United States, this S&P 100 company with all its record-breaking numbers, is firmly, and I mean firmly, planted in the financial distress zone. All that operational strength we just talked about is sitting on top of a score that is flashing a giant bright red warning light for potential bankruptcy risk.
You see, that Z-score isn't just one number. It's a symptom of a much deeper problem. So let's break down the components that feed into this massive warning signal. First, the debt-to-equity ratio, 11.2. Let me be perfectly clear, this is an absolutely astronomical number. For a normal company, a ratio of 2, maybe 3 is considered pretty high. At 11.2, it means for every single dollar of owner's capital in this business, SPG has borrowed over $11. This company is a fortress built almost entirely with borrowed money, and that leaves a razor-thin cushion for error. Next, look at the interest coverage ratio, 3.36. Think of this as your safety buffer. It measures how many times the company's earnings can cover its interest payments. A safe number is usually 5 or higher. At 3.36, SPG's buffer is thin, real thin. If their profits dip even slightly, say in a recession, they could suddenly find themselves unable to pay the interest on that massive pile of debt. Then you've got the current ratio at 0.7. This is a classic liquidity test. It means they have only 70 cents of liquid assets like cash for every dollar of short-term bills they have to pay within the next year. It suggests they might have to sell assets or take on even more debt just to pay their immediate bills. That's a dangerous game to play. And finally, that dividend payout ratio of 1.22. This is a huge red flag. A ratio over 1 means you are paying out more in dividends than you are actually earning. In this case, 122%. How is that even possible? Well, it strongly suggests the dividend, that beautiful dividend we just praised, isn't being funded by sustainable profits. It's likely being funded by borrowing more money. They're borrowing money to pay shareholders. Each one of these is a serious crack. Together, they paint a picture of a foundation under severe, severe stress.
And here's the sleight of hand. The headline earnings per share number for Q4 was a stunning $9.35. You know what the analyst estimate was? $1.84. So how did they blow it out of the water like that? Well, it wasn't from selling more leases or raising rents. It was because of a nearly $3 billion non-cash gain related to an acquisition. This is just an accounting entry. It's not real cash that hit their bank account. When you strip out these kinds of one-time, non-operational accounting gimmicks, the picture of profitability looks much, much different and, frankly, far less impressive. The glowing headline? It was an illusion.
So now we have 2 completely conflicting stories. A story of elite, best-in-class operational performance and a story of severe underlying financial risk. So which one is real? Which one actually matters more? This is the stress test. Let's put these arguments head-to-head, right now, and see which one bends and which one breaks.
All right, so on the bull side, you've got the engine, a record $4.8 billion in FFO. This is a high-performance machine just pumping out massive amounts of cash. You cannot deny that power. This cash flow is what lets them reinvest in their properties and pay that growing dividend. But a powerful engine is absolutely useless if it's bolted to a weak frame. A debt-to-equity ratio of 11.2 isn't just weak, it's brittle. It means the company has almost zero equity cushion to absorb any kind of shock. The engine's horsepower is undeniable, but the frame itself is dangerously over-leveraged. You hit one serious economic pothole, and that powerful engine could rip itself right out of the chassis.
And the bulls will immediately point to the tenants. 96.4% occupancy, soaring sales from the retailers. The building is full of paying customers who are doing better than ever. That proves the business model is as solid as a rock. The quality of the assets is undeniable. But being full doesn't matter if you can't make the mortgage payment. The interest coverage ratio of only 3.36 is the immediate counterpunch. It asks a really simple but brutal question. Is there enough cash left over to comfortably cover the interest on that mountain of debt? At 3.36, the answer is just barely. They are running this business with absolutely no safety margin. Any little dip in that occupancy, any slowdown in retailer sales, and they could find themselves underwater on their debt payments almost overnight.
Look, the bull's going to tell you to follow this smart money. Institutional ownership is over 90%. The biggest funds in the world own this stock. That is a massive vote of confidence from the professionals who do this for a living. They see the quality of the assets and the cash flow. But that smart money isn't there for stability. They're there for the ride. And a beta of 1.39 tells you exactly what kind of ride it's going to be. See, a beta over 1 means the stock is more volatile than the market. A beta of 1.39 means if the S&P 500 drops 10%, you should expect SPG to drop almost 14%. So yeah, the big money's in, but they have the risk models to handle that kind of pain. For a retail investor, this isn't a sign of confidence, it's a sign of extreme risk. This stock will amplify any market downturn. And believe me, that leverage will cut both ways.
So, we've laid out the pristine bull case and the deeply unsettling bear case. We've stress-tested the arguments. It's a high-performance operator carrying a high-risk balance sheet. So what's the final verdict? Where do we here at Iron Financial actually land on this? It's time to synthesize these conflicting data points and forge a clear position for you.
Let's just boil it all down. The bull case is simple. This is the best house on the block. A Class A operator, record cash flow, nearly full properties, and a dividend that just keeps on growing. But the bear case is just as simple. That beautiful house was paid for with a risky, adjustable-rate mortgage that's 10 times its value, and the owner has just enough cash to make the monthly payment and nothing else. The crucial thing you have to understand is that both of these statements are true at the same time.
And that leads us to our unified verdict. Simon Property Group is a high-performance machine running on high-octane debt. The operational excellence is not a myth. That cash flow is real. The quality of their properties is absolutely undeniable. But the structural risks from their balance sheet are just as real, and they are severe. So this isn't a simple buy or sell. This is a company with a very specific and a very aggressive risk profile. You are buying operational excellence, but you are also buying extreme financial leverage. Period.
So this is not an investment for everyone. It's for a very specific type of investor, and before you even think about it, you need to follow these steps. First, honestly assess your own risk tolerance. Can your portfolio actually absorb the hit if this company's high-wire act fails? Can you stomach that 1.39 beta in a down market? Second, analyze the yield. Is that dividend, which is attractive right now, is it enough of a reward to justify the significant risks we've just outlined? You are being paid to take on this balance sheet risk, so is the payment high enough for you? And third, and this is non-negotiable, if you do invest, you must monitor the debt levels like a hawk. Every single quarter you need to be looking at that interest coverage ratio and the debt to equity. Any sign that those are getting worse should be an immediate red flag for you to get out.
So that's our final analysis. Simon Property Group is a Formula One engine that's been bolted to a frame held together with leverage. It's going to be fast and it's going to be powerful, but the risk of a catastrophic failure is always present. The returns could be fantastic, but the potential for a complete wipeout is not zero. So the final question, it isn't for us, it's for you. After seeing the blueprints, after we've inspected the engine and tested the foundation, do you have the stomach for the ride? That's the kind of tough question we help you answer here at Iron Financial. Thanks for watching.